No, it's priced in. Nah, it's priced in.
In accordance with the laws of the state of Nevada, this court.
No, it's priced in. All right, ladies and gentlemen, if you haven't figured it out by now, today's watch list is going to be a little bit different, and I thought we should talk about the mysterious nature of things being priced in. It seems like over the last few years, no matter what happens in the market, everybody's answer is, it's already priced in. It's already priced in. So this came as a question today from Eric on stream. It was a really good question, and I think it relates to everything we have going on with how the market's moving, how the Fed futures and the bonds, even the earnings plays. We hit another 1,000%er on TSM, $60 into just under $600, and all of this is an answer of things being priced in. So it's a pretty complex topic. I thought I would touch on a lot of different things and give you some pretty easy to understand examples so that this could help you moving forward and give you some ideas and things to look at. Now, before I do any of that, we still have a market open tomorrow. We have to deal with a little bit of data. There is going to be the consumer sentiment, and that will be our only set of data there in the morning, and that has the ability to move things. But if you didn't see what happened today, the market found a way to go back up. We're still holding that 1 month range of being in the same range, but what happened that was a little bit spooky, the bond market kept going lower, yields kept going higher, the dollar kept climbing. And why? There was a couple of reasons. One, it was TSM earnings. It spurred all of the chip makers. People got excited about that in AI. That's why we hit 1,000%er on that. After hours, SMCI, they raised their guidance. That's another thing relating to being priced in. And then on top of it, that little 3-month delay in the whole government spending, they got one until March. So there's a lot that we have to digest here, but I think tomorrow should be very straightforward. It's a big option expiration, and I think afterwards we will start moving bigger. But here's the last thing I got to give you. Today and yesterday, there was a Hindenburg omen that has been triggered. If you want to search the trading fraternity Hindenburg omen, I made videos on this in the past, the last time it's happened, and what it is saying is that 2.2% of stocks are hitting 52-week highs, while 2.2% of stocks are hitting 52-week lows, while the market is trading above its 50-day moving average, and that is usually a sign of impending volatility. A lot of people want to say it means there's going to be a crash, but what we've come to realize, it either means you are going to rocket up or you are probably going to die. It could also point to volatility to the upside. So I'm going to leave you all with that. I hope I see you on stream tomorrow, and what I need from you now, a thumbs up on the video. Make sure you're subscribed. And speaking of stream, if you don't know, baby, we are live every single day, Monday through Friday, 30 minutes before open, youtube.com/thestockmarket. We will see you there in the morning. But now, let us get into this tricky topic, man, of things being priced in. I know you have heard this, and I hope by the end of this you are able to learn a little bit. So let's start with the first key. Just because something is expected, it doesn't mean that it's priced in. Like I told you, we were on stream today, and we had Raphael Bostic, and he came on, and he said exactly what he has said in the past, and if you heard the other Fed speakers before, some of that may have not been priced in, let alone expected. There was a big market reaction, but ironically enough today, he said the same exact thing. There was a reaction, and then by the end of the day, you did bounce up, but Eric was asking, why in the world did this happen if everybody knew what he was going to say? And this is your first lesson right now. Just because something is expected, it does not mean that it is priced in and showing up on an asset, equity, option, whatever you're looking at. But now on the other hand, if you do notice that the price of something is higher or lower based on what is expected, then that is how you know it is priced in. The answer for today, how come Raphael Bostic wasn't priced in? Because this is the dilemma we have been dealing with. Although people may expect the Fed members to sound bearish, sound hawkish as of late, if you go look at the Fed futures, the price of the bonds here, and what people expect the rates to be at, those prices are still indicating something dovish, and that is where we are running into problems. That's why you could get some moves, and that's why it is very complex to price things in or not. Now, maybe this is all too confusing. I want to simplify this for you, and that's why I have two examples. Let's start with the first one. You are a 16-year-old driver. You just got your license. Even though you have never crashed a vehicle, your insurance premium will cost more. Why? Because they are pricing in the risk that you have as a driver. You haven't crashed the car ever or yet, but they are expecting a higher likelihood of an accident, and that's why they are charging you more money. Again, if the price is higher or lower based on that expectation, then it is priced in. That's a very simple example. Yes, the markets are complex, and you'll see as we get into it, but this is a very good place to build your foundation in terms of things being priced in or not. If it's not priced in and showing up on the price, even if it's expected or not, that is what you are looking for. The second example, you are a 50-year-old person. You have never missed a payment on any of your credit cards. You've had a steady job for 20 or 30 years. If you go bankrupt, that is most likely not going to be priced in, and I'm sure all of the banks leading up to it probably gave you a loan at a lower interest rate. They looked at your history and said, based on this, well, yeah, every person may not pay money back. That's why we're going to charge you interest. We're giving you our money, but they're going to charge you a lower amount. But if you go bankrupt, they were charging you so low because of your past history, they didn't expect you to do anything, and they priced that in. But the event of you going bankrupt, there's really no way you could have priced that in. That's why all the time when you hear of like a big company, you even think like FTX and that going bust, everybody thought they were really solid no matter what you thought about it. There's no way you could have priced that in because the history on it, you were like, okay, that's good. People, you may have expected it, but if you looked around, that wasn't the price of the FTP token or whatever it was until people found out what was going on, and that's why it was such a gigantic decline. So hopefully these examples can help you out now, but in terms of the stock market, where should you be looking to understand where things are priced in? There's a couple of things that we could look at. It is options, earnings, the index, and the bonds. So we already talked about the bonds. We'll get back to that one at the end. That's where all of this started from, but let's take a little bit and look at the options. I've showed you this with that tutorial at the beginning of the month. You know, we're hitting these 1,000% plays. We're going over the option chain, and we're saying, hey, if an event is supposed to happen on a company, most likely the price of that option will be higher or lower to indicate what is expected. A lot of times, the options, the market makers, they're right on the money. If they're saying, well, nothing outside of expectations are going to occur, they are pricing it to move generally like it has in the past, and they're factoring in a couple of new things. And this is what you got to look at. When I'm looking for a cheaper or more expensive option, I look at the price, because if that price is higher, and especially if the play is further out of the money and unexpected, there is a higher likelihood of a surprise being priced in. By charging a higher price, even though the expectations may be there or not, even if the reality of the event is surprising or not, by charging a higher price on the options, the market makers, the other parties who are willing to sell or buy those options, by having a higher price, they are accounting for those surprises happening. That means it is priced in. If you pay a higher price for an option and it moves 10-20%, but you paid 50% more for that option, it may not move a lot because that high price has priced it in. On the contrary, now, if there is a lower price on an option, you start looking at the chain even a little bit further out the money. It's not costing a lot. You've seen this. You see this a lot on the short terms. That's why people like the dailies, because people try to figure out there's a lot of certainty on a short amount of time. The prices go lower. They're like, yeah, nothing's going to happen. But if you see a lower price on a stock, it either means there's a lower likelihood of a surprise being priced in, or nothing is going to happen. But again, even if there is an expectation, if the price is lower and people aren't paying to reflect that price, there's a good chance what is happening or what could happen a surprise for that nature is not being priced in. So this is the simple one. We've talked about this a lot. Again, this is the whole notion of going to the option chain. You go and see, and you'll notice even on earnings, I've showed you this one with like companies like Netflix and whatnot. You go to the option chain, you could type it in. You'll notice here there's a plus or minus. This is saying how many dollars are priced in. This is literally where implied volatility is getting some of its info from. But what we said, you go to a company on earnings, and most of the time, the contract week of earnings, the options will have a higher price because there is an event that's going on. Sometimes, if people don't expect a lot for an event or had already had news prior to it, the pricing could change depending on that. This is the simplest thing and a very valuable thing. If you didn't go check out the tutorial, how we turn $600 into $7,000, I posted that at the beginning of the year. That will definitely help you out with this concept and teach you a little bit about the options. But hopefully you're understanding on that one. But now let's talk a little bit about the earnings. This one is very important because I'm sure you have seen earnings come out on a company, and depending on the result, how many times have you seen it? A company may have quote-unquote beat or had a good earnings, and the stock goes down, and vice versa. We've seen companies lose billions of dollars, and the stock will rocket up. Why? It depends on what was priced in. If you're not aware, companies give guidance every quarter. Not all of them, but most of them. They give a quarterly update and they say, this is what we are expecting to do next quarter. Once people get that, they start buying and selling the company off of this. The price will change depending on what they said about the future. And then the analysts go on, and these are the guys who study the companies. You should see my other video on analysts. A lot of the time they're wrong, but unfortunately, they do affect companies and how they react, and this is where it comes down to things being priced in or not, because if analysts are expecting a company to do better than their results, than the guidance that they gave in the prior quarter, if they are expecting them to do better, the company says we're going to make $1 billion, and the analysts are saying, no, we noticed the trends and this and that, we think they're going to make $1.2 billion, then if they have a better earnings, chances are the results are priced in, and that's why sometimes ahead of the earnings, the stock will go up. These analysts upgrade it. They are saying, no, we expect them to do better. People react. They buy the stock. The stock is getting priced in for a better expectation. They expect it to happen, and then the price is going up. They are buying into that expectation. That's where something is priced in. On the contrary, this is where it gets a little confusing, because sometimes the analysts will say, no, the company is going to do a lot worse, and they're saying, we don't think the company will do good. They'll start selling it off, and people will react to that expectation and sell the stock off ahead of earnings, maybe 3 months ahead of their earnings, and then the company comes out. A good example is Micron, and they're saying we have negative margins, we did very bad, and we have a lot of problems here, and then the stock will go up, and people are like, why did that happen? It's supposed to die, because this idea and expectation of them doing bad by people already selling it, they have already priced that in. A bad result will not be as shocking. So where do the surprises happen? It's when the analysts are matched up with the companies. The company's like, we're going to make $1 billion, and analysts are like, okay, that sounds about right. And then they do really good, and they make $2 billion. The stock surges. A good example is Netflix. As of recently, if you go see that run-up, everybody was like, no, they're not going to sign up anybody. They're only going to get 1 million members, and boom, they got 7 million members. Not one person was expecting it. The stock goes up 20%, and vice versa. When you saw a lot of these companies start to fall off of a cliff after 2021, 2022, it's because everyone was like, no, they're going to do good. They could withstand all of this, and then they would be like, yeah, nobody's buying chips anymore. I guess crypto hurt us in this area, whatever. You could fill in the blanks, but nobody was expecting it. Bad result comes out, and then the stock does drop because people were not forecasting that, whether they expected it or not. Even if some people did, if the price did not go according to that, and again, you could use the options ahead of those events to see that, those events were not priced in. So this is why, if you ever been on stream, I'll give you a basic example without needing any crazy tools. You could go to like Yahoo Finance, even NASDAQ.com, and just go to the analysis side, and it'll tell you how many analysts are on a stock and what they're looking for. Like today was TSM. The guidance people were expecting on average was 18.2, and they came out and said we're going to make anywhere from 18.0 to 18.8, higher than the highest estimate. and that's why people are like, oh yeah, that guidance is good. And they also had a lot of other metrics that went up, but you have to go see what the company has already priced in. That's why if you come on stream ahead of earnings, there's a reason why I do those earnings previews. I go over every company that is going to be reporting, and I share with you, here are the numbers that the company's expecting, and then if there is that information available, we go and see what the analysts are expecting to get a general idea of what is priced in or not, and then we go to the option chain and do our analysis. So hopefully this is helping you out. Another big one right here that you got to be looking for is the indexes, and they price things in. Now, this is related to the options as well, but when there's a lot of macro events or global tensions going on, you have to go look at the index insurance, what people are playing both ways or how they are trying to balance it out. This is what we call a lot of the time event risk. And how can you know? How do you know if a non-farm payrolls, a CPI, or again, something happens in the world, there's a crazy event, maybe another war gets started, you go to the S&P 500 and go look at the shorter term options, and you do the same calculation like you would if it was earnings, and you see the break even for the at the money plays. So right now, even coming into tomorrow, it's a big expiration, and you'll notice next week's they're all a little bit higher in terms of the dollar amount, but it is about $2.86 being priced in. The market's already closed. It's going to open up tomorrow. This is a great place to start looking at what is going to be priced in for tomorrow. And what do? Take 286 and divide it by the price of the S&P, 476.49, and we are left with 0.006. So what does this mean? For tomorrow, there is a chance, and the market is already expecting and putting a dollar amount that the market will move just over 0.5%. So guess what? If it moves more than 0.5%, that means it wasn't priced in. If we go up 1%, if the consumer sentiment has a blowout number, that would be unexpected. It wouldn't be priced in. So if you get that result tomorrow, the consumer sentiment absolutely plummets, and then the market rockets up 2%. If you were like, it's priced in, you can't really say that, because coming into today, it's saying it's expecting about 0.06, but vice versa. If that data comes out, the market shoots up, shoots down, dances around, and before you know it, we even close at 0.5, 0.4, even at 0.06 or 0.6, 0.5%, then that means it was all priced in. Although events did happen, yeah, we could have got this and that based on the price and what people were willing to pay. You'll see that expectation there and how people decided to move around. It's not like it was anything out of the ordinary. So hopefully you understand, and hopefully you're seeing how all of this links in. And now the final part, this is what we started with today. The Fed futures and the bonds. Oh, it's kind of a little weird. You got to see up here. But the bonds, the Fed futures, this is one of the #1 ways to see what the bonds are really pricing in. Even the yield on a bond tells you something. You got to think about it. That's why an inverted yield curve in a yield curve, a normal one, is so important, because shorter term yields should be lower because expectations should be more certain. Let me give you an example. Like I just showed you with these option chains, depending on which date you're looking for in the risk. But what do you notice about these numbers? We start at the weekly, the daily, 0.4, 2.8, 4.0, 4.7, 5.4, 6.1, 7.4. Let's go down. Let's get to the end of the year, $71. That is a lot different. Let's go to the next year, $135. What should happen? Shorter time frames should be lower than longer time frames. For the last 2 years, almost the longest since 1929 at this point, the bonds have been doing the exact opposite. That's why you have an inverted yield curve, but the yield on a bond and the duration, it is telling you something about what people are expecting and pricing in for the future. That is why when Powell and the whole gang said they're going to do stuff, all of the bonds, what people expected in the next 3 months, 2 year, 10 year, etc., it started to move. The Fed futures today, this is the dilemma right now, because whatever you think is expected, whatever you think the Fed people are going to be, so they're going to sound sketchy, the market should price that in and be ready. Unfortunately, they're not. You go to the Fed futures, this is that thing we've showed you all the time, and you could just go to investing.com, just Google Fed Rate Monitor Tool, and you'll find the investing.com link. You go to these Fed futures, go to December, the market is still pricing in 6 rate cuts by the end of the year. Powell and the Fed, their dot plot last showed 4. The market's saying, nah, we're going to get 6. Not too long ago, it was just saying 7 rate hikes. So even though people might expect that Powell and the gang is going to fight back or the data is going to do something, although that expectation exists, it's not being priced in. Right now, even though the Fed's saying 4 rate cuts and people could expect a rate cut, the market is pricing in more of that. And that's kind of the dilemma, is because you have everybody arguing, well, wait, we knew that would happen. We didn't know that's going to happen. That's why when data is coming out unexpectedly and has the ability to move things, that's what's causing these knee-jerk reactions, because we are pricing in one thing and either the data or an event is causing something else. So simply, if a Fed speaker is saying a bunch of stuff and it may not sound good, and even though you expected it to happen, if the bonds and the Fed futures are not trading and moving, or maybe they have a knee-jerk reaction and come back up, if that pricing and what people are willing to pay for that in the future does not change, technically it's not priced in. So that's where it's like, okay, maybe it should have been priced in. Yeah, he was very bearish, but the market is only pricing in bullish right now. So to wrap it up and to keep it simple, expectations can affect pricing, but not everything that is expected is priced in. And this is the paradox. And hopefully you see it, because unfortunately, all of these things work together. The options, the events, every company has so many events going on, the earnings and different analysts, and there's a wide range of the analysis, the index. Sometimes things aren't priced in, and then something happens, and then it quickly gets priced in, and then you're now operating off of that. And if it's priced in and it charges a higher price, you may go for the play, and then the situation calms down. You paid the higher premium of after it was expected in a higher probability, and then things start to move around once again. And then the bonds are in their own land and they're affected by a lot of things. It is very complex. So hopefully you get a good idea and you could watch all of these. And this is where you got to have to know what to work in or not. But as we're watching the market and different dynamics are playing out, you got to keep this in mind. Things can happen that are expected and people's expectations can change, but what the price is saying, that is what is really communicating what is actually priced in or not. And I hope you enjoyed this one. So, Chad, that's all I have for you. I will see you tomorrow. And let me know if you have any questions. And I don't know, I've been in a tutorial mood this year. So if you want me to make a video, maybe a part 2 to this or anything, let me know in the comments. Have a good night and earn.